as far as I can understand, is you as an NBFC are playing with a certain amount of money that you have. And then you want to be profitable, and I hope you are profitable. And I really wish every startup is profitable. But what is that inherent risk in this whole process for you as a company?
Good question. See, the inherent risk is always the lending risk, right? When we lend to others, there is a risk.
Correct.
Right? The risk of collections, the risk of customers' business, the inherent risk, when you said, the risk of customers' business not doing well. Or there are cases where he may get into a lot of other things and he may not be able to run his business. That risk we always have. But having said that, if you look at the model, right, in our model in which we operate, we have an anchor that is a distributor, and he is supplying into his dealer or retailer.
Okay.
Now, in this model, we have a long-standing relationship. Right? It is not that I am giving a personal loan or direct business loan to somebody.
Okay.
It is a closed loop ecosystem. Quid operates only in a closed loop ecosystem, where there is a distributor whom we call it as anchor, and he has a vintage with a dealer or retailer.
Okay.
And we check a lot of other data points. Right? There is a 3-year business vintage. What is the GST that the kind of GST that is getting filed? How is this business doing overall? This bureau. See, all in all, we have a concept called Quid score. And in Quid score, we check close to 110 different parameters before we decide to give loan to a particular retailer or not.
Can you tell us at least 5 or 6 so that we...
Yeah. See, as I said, the vintage between the supplier and the buyer, right? How long is he working with this borrower, with this borrower, right?
Okay.
That is one. The second is his bureau, right? The bureau, what is his score? What is his historical behavior? Is he paying a loan on time? Has he defaulted on any other loans in the previous 3 years, 6 years, right? That is getting checked.
Okay.
Now is GST data, right?
Okay.
GST, how is his GST filing? Is the business growing as per the GST? Right? We also check the KYC data, right? Who is this person? Where is he residing? Because of the tech and the advanced device systems that is available in the market and which Quid has implemented beautifully, the entire concept of lending has changed.
Correct.
Today, lenders have more confidence when they lend because of the availability of data. And to our advantage, the idea is when we use this data, to analyze and decide whether we lend to a person or no. And if we decide to lend, how much can we lend?
Okay.
Data is something which is playing a major role today for lenders like us or fintechs like us to decide whom to lend and whom not to lend.
Since you deal with B2B, right? It's businesses to businesses. Is it easier to lend? Because B2C is always a risk. Because there is a high chance of defaulting. So, is the risk of defaulting lesser when you deal with a B2B point of view?
Technically, yes. The simple reason is if you look at the statistics, personal loan portfolio, when banks or lenders directly lend to a person, the average NPAs are very high.
What is an NPA?
NPA is non-performing assets.
Okay.
When the bank lends and the money doesn't come back, they call it NPA.
NPA.
There's a yes. Now that is the risk the banks take. Right? That is one product. But if you look at any banks which is also doing supply chain finance or any lender which does supply chain finance, because it is a closed loop ecosystem, the NPA rates, the default rates are extremely low.
Okay.
Right? Because it is always in the closed loop.
Correct.
So a business, let's say an MSME or an SME, simply will not stop business with a particular supplier and then vanish one fine day.
Okay.
It doesn't usually happen. There is a risk. Okay. I'm not saying that there's no risk at all. But if you compare these two products, the personal loan or the direct lending versus the product that we are doing, the default rates are extremely minimal. That I can say with confidence.
So, as a receiver or someone who's benefiting from the services you are giving, the client or the business doesn't have to keep anything as a collateral, right? But what is your collateral? Because there's one question that I've always had. How do fintechs operate? What is that big level of collateral that fintechs usually keep and then get monies from the bank? What is that?
See, there's no concept of collateral in this case.
Okay.
It's pure unsecured collateral.
Right.
There's no collateral.
But for you, is there no collateral that you have?
No, nobody has the concept of collateral in the product that we today do.
Okay.
Right? There are two types of loans: secured loans and unsecured loans.
Okay.
The secured loan is something which you are referring to, right? There's a
Right.
collateral, and then against that collateral they lend.
Correct.
But the unsecured loan, as such, there is no collateral. Right? So we rely on the data, we rely on the size of the business, we rely on a lot of data points. As I said, there are 110 parameters. The system automatically checks all these things before it takes a call. It's basically an algorithm, right?
Right.
It then decides whether we lend or don't lend.